Today, we are going to learn about market structure and liquidity entry model. But before we start the video, I want to show you a trade we took on Aussie USD using the simple entry model that you are about to learn. Market structure and liquidity. These two different price action trading concepts, when combined, create one of the best trading setups. Take a look at this price structure here. We have a large downward move forming a lower low, pullback to form a higher low, push down to form an equal low. Then we have a higher low, another push down to form a lower low, a higher low, another lower low, and finally a higher high. And then we have this break in structure here, which brings us into higher highs. The market was on a clear downtrend, making lower highs and lower lows. And immediately, we got a clear close above the previous high, giving us this break of structure. This is a clear indication of a change in the direction of the trend, so we had to look for an entry. Okay, so we've just made that shift from bearish to bullish, right? We've seen this structure shifting up. Now we have a bullish impulse. This becomes a bullish trend, or bullish market. So this is our high, this is our low. The market then comes back and forms this higher low, pullback, before coming down to make this equal low. Now, the reason that we don't really want to consider this intermediate structure is that this is what we call the consolidation. We will talk more about that later in the video. We don't really want to trade a consolidating market. What we can see that this area here, the market didn't really make any movements other than sideways. It's only when we broke through into the next high at this level here that we continued with the bullish trend. So it's kind of just a pause in the trend where the market does nothing but go sideways. So at this point, we have a bullish trend, we've got the impulses that we want to see, we've got the smaller corrections, and then we've got this consolidation. Now, what forms during a consolidation? Well, consolidation areas are where we are going to get these equal lows. So here we can see one, two pushes down, and then a little bit lower down on the second one. We could pretty safely say that this area here as a whole, if we wanted to get really refined, it would be this area that I've just marked out, which can be seen as a support in price. So there are going to be buyers somewhere within this range. There will be breakout traders at this point now looking for a break below this low. So traders who are expecting, if this happens, their sell stops will trigger them into sells for a break, retest, continuation, and there will also be buyers taking place anywhere inside of this range. Could be here, could be even where we are now, could have been at this support, retest, whatever. But these buyers are going to generally, in mass, at least a lot of them, as a generalization, have stop losses below these equal lows and below this low. So this creates an area where there is a significant amount of liquidity orders or transactions, which means if the market reaches back into this point, such as a sweep below the swing low, we would then look for a continuation high. That's what we expected to see. Okay, at this point, we now had to consider the final thing for our entry, the demand zone. We will talk more about that later in the video, but a demand zone is a consolidation area before a large upward move. Now, this candle here, before the impulsive move, is what we consider our consolidation area. This is the last candle before the bullish impulse that broke the structure. So this here, this large candle, this large bearish candle, is our demand zone. Okay, so at this point, we've got a few confluences. Let me annotate. We've got our high, which indicates a new bullish trend. We've got our demand zone, which indicates a solid level to buy from once the market reacts to it once again, because it was seen as a premium to buy from before. And we've got equal low liquidity, just below the consolidation, which is going to be pretty much this level here, right? So we have our bullish trend, we have the formation of equal lows within that bullish trend. The way we approach this type of trade is, for the market to sweep equal lows, trade into demand, and then we will be looking to buy the market up from there. So we placed an order. Our buy limit was at this level here. The best way to get into these trades is a buy limit, because a buy limit just triggers you. When the market reaches that level, you'll get triggered into a buy. And then, if the market reverses, as we expect it to, you will then profit. For the stop loss, I like to keep it below the recent low. We could put it below the demand zone. That would be fine. Simply because we're so close to the low here, I did actually put it just below the low, just in case the market decides to wick or anything. Now, targets-wise, what we did, because we are now in a bullish trend, is we just looked for open areas above for targets, either points of liquidity, swing high, or just areas of supply, which would be basically the opposite of a demand zone, a consolidation before a large downward move. So if we go take a look at the top of this movement, we have here our area of consolidation before this larger move. We use this as a target. Okay, that is our supply zone, and the trade ended up on a 6R profit. The combination of liquidity and market structure makes trading very simple and easy. At the end of this video, you will learn the two concepts and how to start using them like a pro. Without further ado, let's get into the main video. So let's start with structure. Market structure is the backbone of every single move the market makes. It's how we determine trend direction, where momentum is shifting, and whether we should be looking for buys or sells. Without structure, you're basically guessing. You're reacting to random candles instead of reading the actual flow of the market. So what is market structure? It's simple. Markets move in three phases: uptrends, downtrends, and consolidation. In an uptrend, we're forming higher highs and higher lows. Each swing high breaks above the previous one. Each swing low stays above the previous low. That's a bullish market. That's where we want to be buying. In a downtrend, we're doing the opposite: lower lows and lower highs. Each low breaks beneath the previous low. Each high fails to reach the previous high. That's a bearish market. That's where we want to be selling. Consolidation is when the market goes sideways. No clear higher highs or lower lows, just back and forth. As I said earlier, we don't trade consolidation most of the time. We wait for a breakout and let the market show us which direction it wants to move. So that's the basic framework: uptrends, downtrends, consolidation. Inside of a trending market, we also need to understand impulsive moves and corrective moves. Impulsive moves are the big, strong movements that actually break structure. These are the legs that push the market higher or lower. They're aggressive, they're fast, they show momentum. Corrective moves are the pullbacks. They don't break any major structure. They're just the market taking a breather before the next impulse. In an uptrend, a corrective move pulls back to form a higher low. In a downtrend, it rallies up to form a lower high. These two types of movement create the rhythm of a trend: impulse, correction, impulse, correction, over and over. When you see a market making impulsive moves in one direction and only corrective moves in the other, you know which way the momentum is going. That's your bias. That's what you trade with. A break of structure is when the market pushes through a key level and confirms the trend is continuing. In an uptrend, a break of structure happens when the price breaks above the previous high. That tells us buyers are still in control and the trend is likely to continue. In a downtrend, a break of structure happens when the price breaks below the previous low. Sellers are in control. Trend continues. These breaks are important because they validate the trend. They tell us the market isn't just drifting, it's actually moving with intent. So let's say we're in a bullish market. We've got higher highs and higher lows forming. The market pushes up, breaks the previous high. That's a break of structure. Then it pulls back to form a new higher low. That pullback is our corrective move. Then the next impulse breaks structure again and takes out the high. That's a clean uptrend. If at any point the market breaks below a higher low, we've now shifted structure. We've gone from bullish to potentially bearish. That break signals a change in momentum. This is why understanding structure is so critical. It keeps you on the right side of the market. It stops you from buying in a downtrend or selling in an uptrend just because you saw a single candle move. You're reading the bigger picture. You're following the flow. Let me give you an example on a chart. We've got a market making higher highs and higher lows. Clean bullish structure. Price pushes up, breaks the previous high, break of structure. Pulls back, forms a higher low. Impulses up again, break structure again. This is a textbook uptrend. Anyone trying to sell this market is fighting the structure. They might catch a little corrective move, sure, but the trend is up. The momentum is up. The highest probability trades are buys. That's what structure does for you. It gives you a bias. It gives you a framework to make decisions inside of. You're not just reacting, you're anticipating based on what the market is already showing you. So that's structure. Simple, logical, repeatable. Uptrends are higher highs and higher lows. Downtrends are lower lows and lower highs. Impulsive moves break structure. Corrective moves don't. Follow the structure. Trade with the trend. Got it? Good. Let's move on. Now, let us look at how liquidity and structure work together. All right, so we've covered structure. We've covered liquidity. Individually, they're useful. Together, they're unstoppable. Structure gives you direction. Liquidity gives you timing. Let me explain. You use structure to tell you whether you should be looking for buys or sells. Then you use liquidity to tell you where the market is going to go before it continues in that structural direction. This gives you precise entries. It gives you high probability setups. It keeps you patient instead of chasing random moves. Let's walk through this example. Looking at this price action, we've got a market in a downtrend. Lower lows, lower highs. Bearish structure. We know we want to be selling, but inside the whole price action, which is bearish, it rallied to form two equal highs. Here, traders are seeing resistance. They're selling here. They've got stop losses just above. What do we know? The market is likely to sweep those equal highs before continuing lower. That's where the liquidity is. We wait for the market to sweep above the highs, grab the liquidity, and then we look for our entry. We enter using a supply zone. A supply zone is the last consolidation or the last candle before a strong bearish impulse. It's an area where sellers previously stepped in and drove price lower. So we look for a supply zone that sits just above or around the equal highs. When the market sweeps the highs and trades into that supply zone, that's our entry. At this point, liquidity has been grabbed, stop losses triggered, buy stops filled. The market has done its thing. The structure is still bearish. The trend is still down. The supply zone is a proven area where sellers have shown interest. That's a high probability short. Stop loss goes just above the supply zone. Target is the next structural low, or the next liquidity pool on the downside, maybe equal lows below the current price. Structure plus liquidity plus zone equals trade. This is the formula. This is a repeatable process. Structure tells you the direction. Liquidity tells you where the market will go first. Zones tell you where to enter once liquidity is swept. That's how they work together. That's how you turn analysis into profit. All right, let's take this framework and apply it to some real charts so you can see exactly how it works in practice. I'm going to walk you through a bullish example, step by step, using everything we've just covered. First, the bullish setup. We're looking at a market that's been trending lower, clean downtrend, lower lows, lower highs. Price was pushing down aggressively, and then we got an impulsive move that broke the previous high. This is a clear indication of the trend shifting from bearish to bullish. It starts to have multiple pullbacks. As it pulls back, we see it forming swing lows that are pretty much level with each other. This price movement can be called a consolidating market. And below this equals, that's our liquidity. We know there are stop losses sitting just below them. We know there are sell stops from breakout traders. We know the market is likely to sweep that level before continuing higher. So we wait. We don't buy at the equal lows. We wait for the sweep. What do we do next? We look for our demand zone. Going back before the impulsive move that broke the structure started, we can see there was a consolidation period, followed by a strong bullish impulse. That consolidation is our demand zone. You see this long wick candle before the impulse? That is our demand zone. That's our entry. We can place a buy limit at the top of the demand zone, or we can wait for a bullish candle to close inside the zone and enter on confirmation. Let's say we enter at the zone, our stop just below the demand zone, or just below the swing low. That keeps our risk tight. The first target is the previous high. The second target is the next area of supply on the upside. That's our extended target. So we've got a trade. What happens? Price consolidated a bit before dropping towards our demand zone. And after that, it rallied. It pushes through the first target, takes out the previous high, break of structure, confirming the trend is still bullish, then it continues higher. That's a clean winner. Structure plus liquidity plus zone equals profit. That's the goal. That's what this framework gives you. Thanks for watching. I'll see you in the next video.